Good evening, everybody. Thank you for joining us here today on this edition of the monthly Outlook call and webinar. Every month, we've been reaching out to all of you through multiple medium to connect and discuss the markets and discuss various factors that are moving the markets. What's our analysis of the current situation? And also, it's good that all of you have been sending in your questions. So we also get an idea about the questions which are on your mind, and we are able to answer those questions. So today, what we are going to do in this session is that first we'll take you through maybe the first 25-30 minutes, a slight presentation, which will cover some aspects of what has been happening in the market over this period of the panic in, I would say, February, March of 2020, and how the patterns have been playing out subsequently. What we'll also do, obviously, is take a look at the valuations and some of the other, key parameters that we see at this point of time. So, without further ado, let me, sort of pull up the presentation that I wanted to share with you today. This should be coming up shortly on your screens. Yeah. So we'll be talking about the equity market outlook. What I wanted to do today was slightly different, which is to first start off by talking about UTI's investment process, because that will give you some insight into both market behavior as well as the way we manage portfolios. And then we will segue into the latter parts of the presentation. Now, at UTI, our investment process, our proprietary investment process, as we call it, is called Score Alpha. Our target. Okay, great. Sorry about that. Experience. Okay.
Vetri, for the interest of everyone, it would be better if you can start from the previous slide. Sorry.
Okay. So, sorry about that technical issue. We are back here again looking at the two factors, which, as I said, are important, which is essentially operating cash flow and return on capital. These are the two factors which are at the heart of the research process carried out by analysts. Operating cash flow is important because profits are based on generally accepted accounting principles, but cash is reality, and a company which does not generate cash cannot reinvest capital in its generate operating cash flow, and it is able to invest some of that cash flow into its business for growth at a return which is higher than cost of capital. Then the business is able to generate wealth. Moving on to the next slide. Uh, what we wanted to do here is just show you the behavior of stock prices during the month of March 2020, which is when, you remember, the index, the Nifty, came down by almost companies on average fell by 26.5%. C2 rated companies fell sharper by 31.4%, and C3 rated companies on average fell by 37.5%. Now, the month of March 31, March 2020 was the month in which the panic about the pandemic was at maximum, and there were concerns about how long it might last. And therefore, in a sense, what this shows you is the flight to safety, where the strongest companies that generating operating cash flow fell the least, and companies with very inconsistent cash flow fell the most. If you look at the right side of this chart, what you'll see is the performance of the stocks from March 31 till today. And as you can see, the behavior almost inverted itself, which is to say, post March 31, 2020, as we started to see some kind of unlock happening, we went into a period where gradually, one by one, the government permitted different parts of the economy to start opening up. We saw the actual reverse, which is the C1 rated companies rallied the least. C2 rated companies, which are more inconsistent in terms of operating cash flow, did better. And the C3 rated companies, which are very, very inconsistent, they actually rallied the most at 51% over that 3-month period from March 31st to June 30th. Uh, Now, in the next slide here, I'm showing you how stocks behaved based on their return on capital during these two periods. So first, you've got the 1-month period ended March 31, 2020 on the left. And as you can see, this table over here, you will see that the least fall was in R1 rated companies. The maximum fall was here in R3 rated companies, right? So the higher the return on capital, the less the stock price falls. The lower the return on capital, again looking at a previous 5-year period, the higher the fall in the stock price. If you look at what happened after March 31, 2020, again the pattern inverts itself as more optimism came in, as the government announced a range of fiscal and monetary policy interventions, as people could visibly see the economy starting to get unlocked. It's actually the poorer quality companies which showed you the best performance, rallying by 51%, whereas the best rated companies, which had performed very well during the fall, rallied, but not as sharply. They rallied only by 25%. So the reason I wanted to share this with you is that once again, it gives you some perspective into how stocks actually behaved during the month where there was complete panic, which is the period ended March 31, 2020, and how stocks behaved in the period subsequently, where, as you can see, the pattern was almost inverted. Uh, Moving on, what we show you in this chart is the period of returns for the 1-year ended periods. This is again important to look at for a very simple reason. And the reason is this. When I showed you the previous chart, you could see over there that the best returns actually came in the bounce back in the R3 rated companies. But on a 1-year basis, the R3 rated companies remain the worst performing stocks in the market even after their significant rally during the quarter ended June. The best performing stocks in the market on a 1-year basis as of June 30th are actually the R1 rated companies, which have actually performed the best over a 1-year period, even though during the period of the rally, they actually did not do as well. So, this is very important to remember because when we are long term investors in the market, it is actually those companies which are C1 rated, R1 rated. Some of them may have cyclicality, but unless they can improve in the future, their returns could be quite poor. So this is important to understand how the market has actually behaved slightly differently during the 3-month periods. But when you stand back and look at it on a 1-year period, things start to look quite different. What we've done on this chart is that we are looking at how stocks performed on the basis of net debt to EBITDA. This essentially tells you how leveraged a company is. Now, as I mentioned, when I talked about the companies rated C1, C2, C3, I said that companies which are inconsistent in terms of their cash flow and also companies which operate in very capital intensive industries typically tend to have a lot more debt. As you can see on this chart, again, it's quite intuitive. If you look at the performance of the stocks, what you will see here is that the best performing stocks during the month of the fall were the companies which had less than zero net debt to EBITDA, which means these were actually net cash companies. They had no debt. The worst performing companies during the fall were actually companies that had net debt to EBITDA of between 1 and 3 or more than 3. These stocks on average fell almost between 31 to 33%. So these were the worst performing stocks during the fall. The higher the ROCE, the higher the cash flow, the less leverage the company, or it was a net cash company, the better the stocks did. During the period March 31 to June 30, the reverse happened, which is The best performance has actually come in leveraged companies, whereas the companies which have zero debt and are actually net cash turned out to be underperformers. So again, we are looking at a very small time capsule. This is the period of literally only 1 month and 3 months, but it gives you an insight into the thought process of the market during this period. Uh, Here on this chart, what I'm showing you is essentially if we break the market up into different sectors, what does the performance look like based on these different sectors? First, we have the non-financials. When we say non-financials, we basically mean companies which are not in the financial services sector. So those companies during the month of the panic fell by 27.5%. The financials companies are categorized here in the next two bars. And if you look at these companies, they effectively had severe underperformance because these two sets of companies that you see here fell by 39% and 28%. These are typically your banks and your non-banking lending institutions. They are by definition leveraged businesses because they either have deposits or they borrow from the bond markets. And as you can see, these were the worst performing stocks during the month of the panic. The financials which were in non-lending businesses actually fell, but they didn't do as badly as the lending businesses. So these companies are essentially asset managers, brokers, wealth managers, exchanges, insurance companies. You can see they fell, but they did not fall as heavily as the lending businesses did. When you look at the recovery period, again, you will notice that the worst performing sector has actually been the lending business, which is the financials business, the lending component. The reason for this, very simple. This is by definition a leveraged business, and we are seeing large amounts of fundraising being announced in this sector as banks and NBFCs look to strengthen their balance sheets and raise more capital. So again, in a sense, this is very logical. As I mentioned earlier, companies that require capital have underperformed. Companies that don't require capital, the non-financials, many of them, as well as the financial companies which are not in lending businesses, have done better during the bounce back. So this is as regards the performance of companies based on sectors. So this is what I wanted to share with you based on the UTI research methodology, how we can understand the mood of the market, the color of the market as it has played out during the last 4 months. These have been very eventful months. Peak to bottom, the Nifty fell by almost 34%. And of course, from the low, we have now seen an equally phenomenal rise. But this gives you some perspective into what the market has been doing and how it behaved over time. How is this relevant to UTI's equity funds? You can see this on the slide. We follow a framework in terms of how we build our portfolios. And what you can see here is that for every fund, which is mentioned on this slide, you can see how much of the portfolio is allocated to R1 rated companies and how much of the portfolio is allocated to R2 to C1 rated companies, right? So the balance allocation is to R2, R3 or to C2, C3. Now, as I mentioned earlier, in UTI, we have a clear bias towards companies which have the track record of generating cash flow and also those companies which consistently generate a high ROE. But different funds have different philosophies. So, for example, UTI Equity Fund has a quality growth and cash flow focus. So, 91% of the portfolio is in R1 rated companies. As compared to that, if you look at our more value oriented strategies, UTI Value Opportunities funds, which use a barbell approach, only 56% of the portfolio is in companies which are rated R1, significantly lower than the 91% that you saw here. Similarly, our deep value strategy, which is core equity, has 51% of the companies in R1 rated companies, which means the balance, 49%, is actually in R2 and R3. So this is how the investment process at UTI, starting from the kind of companies, the way we classify them based on operating cash flow, and the way we categorize them based on their high return on capital or otherwise, becomes a building block into the way that we actually build the portfolios. Consistently, you will find that our portfolios tend to have high numbers when it comes to operating cash flows. That's because we think this is almost a hygiene factor. Without this hygiene factor, you are at great risk. So all our portfolios tend to have a bias towards companies which have consistent cash flow generation. Uh, I will now move on from this section to talk more about where we are placed in terms of the markets and in terms of valuations. So this section is really more about market valuations and market outlook. Now, all of you are aware that during this, 3 to 4 month period after the pandemic became fully visible, there have been significant cuts which have been happening to earnings estimates across the board. So on this slide, slide number 13, what you see here is essentially the trend in consensus Nifty EPS estimates over the entire period. Now, each of these lines shows you the EPS estimate for a particular year. So starting from FY18 to FY22, you can see the trend in EPS forecast. Now, two, three things to note over here. Every year, the line actually keeps declining. So every year, people start with high estimates, and then after that, the estimates start getting cut. Because of the pandemic, right, which started here in February, March, there has been a dramatic collapse in the earnings estimates for FY21, which is March 21. So from almost 650 rupees EPS estimate, it has come down to 500, and in fact, I think as of now, I think it's even headed below 500. And as of March 31st, while the forecast was that your March 20 EPS would be 573, in reality, the number is right now somewhere here, which is about 470, because a lot of the earnings estimates which have been announced, a lot of the earnings that have been announced in the last 2 months as we went through the earnings season in April and May, many were disappointing. And as a result, the final earnings for March 20 itself declined to about 470. In a way, earnings are now almost unchanged for about 3 years. Uh, Obviously, there has been a problem with overestimation of earnings growth for many years now. But I would also say that looking at the FY21 estimate does not mean much today, because this is only 1 year's earnings. Stocks are not priced on the basis of 1 year's earnings. They are priced on the basis of cash flow that the company will generate over a lifetime. There is very strong growth estimates right now for March 22. We don't know how authentic that is. There could be some downside, because as we still don't know how and when the economy will actually exit from this problem of the pandemic. Yes, we are normalizing, but we are only at 80-90%. We haven't yet gotten back to a period of positive growth. So this is one challenge as far as the earnings growths are concerned. In terms of valuations, what this means, you can see here this chart. This is the trailing PE. There was a point in time in March when the markets became very cheap, but now we have actually moved back to the expensive territory as far as valuations are concerned on a trailing basis. So the market is not as attractive as it was in March. But I'll give you some more color on valuations over the next few slides. This is the trailing PE multiple. The next chart shows you the forward PE multiple. Now, this chart currently I would tend to disregard, because FY21 is clearly distorted earnings due to the lockdown. Uh, More likely, we get a better normalized picture of earnings only in FY22. So I would really not pay too much attention to this chart, which is showing you a forward P which has spiked, but that's really the impact of the damage to FY21 earnings. The trailing P multiple is also expensive, but not as expensive as this. However, if you look at this metric on this chart, which is the price to book multiple, it basically shows you that the market, despite the rally, is still in fair value zone. In fact, it has just about reached slightly below the long-term average price to book. Of course, return on equity in India is also much lower than what it has been in the past. But between the PE and the price to book, I would essentially say that now valuations not as attractive as they were at the lowest point in March, but I still wouldn't call it extremely overdone or extremely rich. There is some dichotomy in valuations between stocks, and that is why the price to book still appears to be in fair value, even though the P multiple has actually spiked to expensive territory. So that is where we are as far as the Nifty valuations are concerned. Uh, Here we have shown the attractiveness of equities compared to bonds. The way to interpret this chart is that when this relative chart goes into positive territory, like it did here, this was in March 20, then it is a very, very attractive period for equities. Uh, from that level, the market has now gone up sharply, and therefore, relative to bonds, we have actually come back to the long-term average, which is this yellow line. So I would say right now, it is only marginally attractive relative to bonds. Now, many of you would know that at UTI, we also run a fund called the Multi-Asset Fund, which uses a model for asset allocation. This model was indicating at the lowest point in March to go to 80% equity allocation in UTI's multi-asset fund. But in the last 2, 3 weeks, as the market has gone up, the model has reacted to the increase in valuations, and therefore from 80% allocation, it has actually pulled back to 70% allocation. Again, reasonably attractive, but not as attractive, and that is why the model is starting to pull back slightly. This is a chart of mid-cap valuations vis-a-vis large-cap valuations. When the gray bars go up into very positive territory, that is when mid-caps can be said to be extremely attractive. We were at such a point in March. Today, the numbers are more or less at parity. So we are not seeing any great attractiveness of mid-caps relative to large caps. They are at more or less the long-term average. So I would say there is no reason to be extra positive or reason to be negative. You can take things pretty much on a bottom-up basis. So this is the picture as indicated by valuations. So finally, just to conclude, I would say 2, 3 things. Economies are emerging from the lockdown, but we still don't know what the trajectory will be in terms of the rate of growth as we exit. There is still a risk of second wave of expansion of infection by way of COVID. Uh, at this point of time, there is large balance sheet expansion happening by central banks, particularly in the US. In India as well, we have seen a lot of monetary policy support being provided, but fiscal policy support has been limited. More will have to be done. India has used this as an opportunity to push through a lot of supply side reform in agriculture by liberalizing labor laws, by providing incentives to domestic manufacturing. These do not have a direct impact on growth, but they enable the economy to grow faster. Uh, a lot of capital will be required to be raised in the financial sector to strengthen balance sheets. We are seeing that happen. The good news, inflation, current account deficit are in comfortable zone, and the outlook for agriculture is positive. Stocks are not as cheap as they were in March 2020, but there are opportunities to invest at different market caps and across different sectors at reasonably fair valuations. So I would say there are still some opportunities, but obviously not as attractive as it was in March. So that's a summary at this point of time in terms of what we wanted to run you through on the presentation. And I hope those slides gave you some perspective about how we think about the market and what are the different parameters that we see, and hopefully it also gave you some insight into UTI's proprietary investment process and how we use it as a building block to identify stocks. We use that same information and that framework to create portfolios, and finally, based on the investment strategy, those become parameters which we monitor and we, in a very disciplined fashion, stick to ensure that portfolios stay consistent over time. So that's it as far as the presentation part of today's outreach goes. What I'll do now is that we've already started to receive some of the questions. I've started receiving some of these questions from viewers. So I'll read out those questions and also give you my thoughts on those. Um, so the first question we have, there has not been any additional measure by the government for some time, both on the fiscal and monetary side. Do you think enough was done to boost sentiments and uplift the economy? This is a very good question. Actually, if you had listened to my last event in June, we had discussed this, that government officials were actually indicating that they would, at some point of time when they thought appropriate, look for an opportunity to actually do more on the fiscal side to provide support to the economy. And just yesterday, the chief economic advisor, when talking in a public forum, almost said the same thing, that we are still battling the virus. Once we have more visibility that the economy is getting back to normal, we will consider more support. I think so far the fiscal support has largely addressed humanitarian issues. It has not done enough to provide some kind of a stimulus to business and industry. And therefore, I think it is certainly important that some kind of fiscal stimulus is supported to business and economy and not just the humanitarian side of it. As far as monetary is concerned, we have already seen an extension of the moratorium. We have also seen significant, policy interventions in terms of monetary support being announced by the central bank. Here again, I think eventually some sector-specific norms and sector-specific interventions for businesses which have been severely disrupted by COVID will be required, and therefore that also will be needed. In a sense, the market is now climbing what they call the wall of worry. This is when everybody is worried, but perhaps the actions from government to sort of address some of these worries is still to be done. And maybe, when we get to that, markets would have already priced it in advance. So I am hopeful and optimistic that the government will do more, particularly on the fiscal side and on the monetary side as well. Some test sector specific interventions will be required. Next question we have. The uncertainties caused by COVID 19 is making it difficult for financial analysts to predict the future and companies' growth potential, and there are constant ground grades. How do you view this scenario? So, I just want to step back for a moment and put this in context. The reality is that forecasting the future in terms of what will happen in any given year and to the earnings of the company has always been difficult. In fact, as some would say, it is virtually impossible. I think what we must recognize is that eventually the value of a stock is not the earnings which are generated in the next 12 months, but it is the value of the cash flows that that business generates over the next 10 years to 20 years. And as we do know, many businesses do continue to remain and thrive because they have that growth opportunity over 10 years and 20 years. Now, when you look at it from that perspective, the focus should not be on prediction of earnings for FY21. That is actually not important in the context of picking good businesses and earning returns from investing in that company and staying invested for a long period of time. So I would actually say that it is not that analysts do a bad job. Yes, they are guilty of being slightly more optimistic at most points of time. But equally, this is actually a reminder to us that the future is uncertain. That is why we must build diversified portfolios. That is why we take less risk when it comes to companies that have inconsistent cash flows. We take less risk when we look at having a higher proportion of companies which are R1 rated. And even when we invest in R2 or R3 rated companies, we do it because when we look at their past history, something tells us that in the past, these companies have had better operating metrics than what they are currently delivering. And therefore, if a certain set of circumstances were to play out, they could see an improvement. So I would actually say the future is always uncertain. That is why the investment process and a diversified basket of stocks in your portfolio is the way to be prepared for uncertainties. One final comment, it is always difficult to predict, as I said. My own experience during the years 2002, almost 18 years ago, from 2002 to 2008, was that every year the actual earnings growth in the market was far superior to what the analysts were predicting at the beginning of the year. That is because that was a period of great macroeconomic growth in India. As you are aware, during that period, GDP growth was averaging almost 8.5%, 9%, and corporate earnings growth was almost 24, 25% during that period. But every year, at the beginning of the year, analysts would say, okay, last year was 25% earnings growth. This year, we think it will slow down to 15%. And they would actually get surprised because earnings would come in stronger. So I would say this is a risk in all forecasts. It is not that analysts are always over optimistic. In that 2003 2008 period, every year they were actually conservative compared to what actually happened. So just an anecdote as far as expectations is concerned. Next question. As equity markets have shown some semblance of rebound, is it because of liquidity? Is it because of fear of missing out? Do you think investors need to exercise some caution? Very good question. Uh, Without doubt, liquidity has made a difference, right? Because when the US Federal Reserve, which had a $4 trillion balance sheet as of uh, 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 29th February, increases the balance sheet by $3.2 trillion in just 10 weeks, right? That's a tremendous amount of liquidity which has been injected into the system. Also, tremendous fiscal support provided to the economy to the tune of almost 5% of GDP, which was $1 trillion in the US. I'm using the US as an example because that was the most aggressive intervention that we saw at a monetary side in terms of liquidity and fiscal side. And clearly, that gave many investors the confidence to say, okay, here is a central bank and a government which are doing whatever they can to ensure that the economy recovers through this difficult period. And therefore, they have chosen to focus on the longer term prospects of the economy rather than what happens in the very, very short term, which is FY21. And therefore, without doubt, this liquidity is a very integral element of what has enabled the markets to rally so strongly. And in any rally, not just this rally, the minute markets go up very sharply, some investors have a sense of being left out, and which is why the fear of missing out, as we call it, FOMO, has certainly again come to the forefront. We do see some signs of that. Uh, but I would also say this much that the last part of your question, which is should one exercise caution, uh, without doubt, as I said in my earlier present part of the presentation when we were looking at valuations, remember that at March, valuations were at a trough. They were comparable to some of the cheapest valuations we have seen in the past. That is no longer true today. By some metrics, stocks have become expensive. By some metrics, they are now sort of closer to fair value. So I would say it is still not blinking red, but clearly it is not as attractive as it used to be. So the case for making an asset allocation shift from bonds or any other asset class into equities is not as attractive as it was 3 or 3.5 months ago. But yes, I still think that there are some signs that market is in the fair value zone. So I would still say, just continue your normal investment, but there is no opportunity anymore to say, I'm 20% invested in equities. Let me raise that to 30% or to 40%. Or if you're 40% invested in equities, to say, let me go to 50%. No, I think the opportunity for the asset allocation shift in favor of equities is now behind us. And as I shared with you, our own internal model has actually reduced allocation rather than increasing allocation, though it is still in the attractive zone, which is why the equity allocation is still above 60%. So, in a sense, we are still positive, but not as much as it we used to be earlier. Uh, Next question, what is your outlook on mid cap and small cap? Is there any change in allocation at a fund house level? So I already covered this in the presentation. Uh, Mid caps were very attractive relative to large caps. Again, unfortunately, 3 months ago. Today, bottom up, we can still find some opportunities, but when we just compare the Nifty mid cap index P multiple to the Nifty 50 P multiple, the gap is gone. So I would say on a top down basis, there is no particular signal we get to favor mid caps over large caps. On a bottom up basis, however, if there are stocks that we like, we are open to buying those mid cap or small cap companies. Uh, I'll also say this much that at a fund house level, uh, we don't follow a policy that in every fund we will shift allocations. So in a UTI equity fund, we consistently keep the mid and small cap allocation at between 35 to 40%. So that allocation will not change based on the relative attractiveness. The fund in which we could move the allocation is in the value opportunities fund, where depending on the attractiveness, we could go down to 20% mid and small if it's unattractive. We could go as high as 35-40% if it's attractive. We are right now at about 30%, but we are not particularly trying to change that allocation, because from a top-down perspective, we are not getting a signal. As I said, on a top-down basis, both appear to be at par at this point of time. Next question. Pharma sector has been an outperformer in the rally. Can investors still enter into it, or have they missed the bus? Uh, I will say this much, that pharma sector is something that we have been positive on for a while, not just because of the performance in the last 3 or 4 months. If you go back and look at the data, many of the UTI funds were significantly overweight pharmaceutical even before that. And in fact, we went through a period of pain of owning pharmaceuticals for almost, I would say, 6 months to a year before we saw the recent performance come through. Our longer term perspective on pharma remains positive, to the extent that we believe the domestic market remains a large growth opportunity for pharmaceutical companies, and the US generics market remains a reasonably attractive pool in terms of profitability, not the way it was 4 years or 5 years ago, but the consolidation in the US market has also now played out. So we think it can be a more stable business, not subject to the volatility that we saw in profits in the past. So our attractiveness of the Indian pharmaceutical companies is rooted primarily in the domestic opportunity. And because they are globally competitive, they will always have a significant export business and significant export profits. Next question. Given the continued pressure on China, led by the recent India-China face-off and continued trade tension, do you think it will help India to focus on several opportunities that will reduce the dependence on global counterparts? If yes, where do you see the initial round of opportunities coming from? I think that is still very early days, but the good thing is that Government of India has clearly seized on this as a policy opportunity, which is to say that there are many multinationals looking to either shift production out of China, or they are looking to de-risk their supply chain, and they need another geography in which they can establish a supply chain. And India has announced several policies to try and attract those companies to come to India. But we are not the only country competing for the attention of these global majors. Countries like Vietnam, Indonesia, Thailand, they are also competing. We have one advantage, which is the attractiveness of our domestic market. In addition to the fact that we can also produce to supply for the export markets. So I think this is something which will eventually certainly play to India's favor, but I don't think it will have immediate overnight benefits. And remember that getting integrated into global supply chains means having lower tariffs. So India needs to explore two things. You need to be able to explore non-tariff based barriers to trade with China, and then allow domestic manufacturing capacity to go up, allow that to become an opportunity to service the domestic market and also produce for the export market. I think this can certainly happen in sectors like electronics, in chemicals. It can also happen in a lot of the machinery related segments. But there is still more that is required in terms of addressing issues related to ease of doing business, issues related to taxation. There is still troubles that companies are facing relating to GST when they export out of India. So there is still some work in progress as far as our ability to attract more companies to set up manufacturing in India is concerned. But the opportunity is certainly there, and this opportunity is there today at for us to use, which we did not have a few years ago. So I think the opportunity is there, but We cannot take it as a given. There are other countries competing with us, and we have to execute on ease of doing business and simplification of taxation to get those companies to come into India and set up their base. Next question. Value style based schemes are doing well in the current market, including UTI Value Opportunities Fund. Do you think the current market is favorable? So let me put this in context. Historically, what we have seen is that when a market gets very cheap and then the market starts to rally on optimism, which could be related to, in this case, normalization of economic growth. It could be related to a pickup in economic growth. Typically, the value component of the market tends to do much better. But as the market gets, as the economy gathers momentum, and perhaps you start to see growth accelerate, and at some point the economy actually has significant growth momentum, and maybe central bank policies start going into reverse gear, which is they start to pull back monetary accommodation. Fiscal support also goes into reverse gear, which means you start contracting the fiscal deficit. Typically, at that point of time, growth does better. But at this point of time, I think clearly the advantage is still with value. But you should be aware that there will come a time where the balance might shift. I would also say that the way we run the Value Opportunities Fund, we run it with what we call a intrinsic value focus. It is not a mere statistical approach of buying only stocks that show up as being bottom quartile cheap on a screener. We want to buy stocks which are cheap relative to expectations. These could be expectations of growth. These could be expectations that nothing might improve for this company. So we think our style of investing in UTI value opportunities is actually a all-weather style of investing. It is not limited to investing only when you see this kind of a pickup in the P multiple from, or in the price to book multiple from being very cheap to normalizing. And if you see the track record of UTI value opportunities over the last, I would say 3 years, it demonstrates that kind of stability to really be a all-weather style of fund management. Yes, value does better from a tough market, and value really starts to pull back when the economic factors in terms of monetary policy and fiscal policy start to pull back. We are nowhere close to that, so I think there is some advantage with value style, and I think our style of UTI value opportunities is really more all-weather. Uh, Next question we have, do you think the way forward for equity investors will be volatile? And should equity investors temper their expectations of a growth revival? So let me put it this way. The markets are always going to be volatile. I have been investing in the markets for 28 years. I have been professionally involved in investing for 26 years, and markets are always volatile. Every 3 to 4 years, you will see the market drop by 25, 35%. Twice in my career, I have seen the markets drop by 50%, and yet over time, the market can create values for investors who are disciplined and investors who stay the course. So I think my answer to the question is that markets will always be volatile. You cannot change the nature of the beast. What you can change is your own behavior, which is to accept that volatility will be part of the journey. Use a strategy like systematic investment plan to overcome the market volatility. Have some kind of a valuation based approach to determine when to shift your asset allocation in favor of stocks and when to shift it slightly away from stocks in some kind of a range that you would want to have for asset allocation. That is the way you will be able to invest in equities and achieve your financial goals. Your returns from equity will always be accompanied by a high degree of volatility. Do not come to equity hoping for low volatility. The high volatility is your friend if you can discipline your mind, if you can discipline your thought process, if you can discipline yourself to not be greedy when markets are going up and to not be fearful when markets are going down. So that to my mind is really the right way that investors should shape their thought process. It has nothing to do with volatility. Uh, Does UTI have a PSU mutual fund? No, we do not have a scheme which invests only in PSU stocks. We may have investment in some public sector companies in different funds, but no, we don't have a fund which invests only in PSU companies. No plans at this point of time to launch such a fund either. We don't have a view on PSU companies. In every sector, we look at companies based on their internal metrics. In many cases, we find that in the same sector, companies are executing better than their public sector counterparts. Then that becomes a reason to choose that company over a public sector enterprise in that sense. But I would again say one should be neutral to the ownership characteristics of the company when making an investment. What is most important is the management running the company in the interest of creating wealth for shareholders, or is the company having to do certain things because it fits into a larger national priority, or it falls into some kind of policy agenda of the government? When that starts to happen, the company becomes an instrument of public policy, and shareholder returns become a secondary criterion rather than the primary criterion. That would give us reason to reconsider whether the business is genuinely attractive. Because from our point of view, the money that investors have given us is to be put to the cause of trying to generate returns for the shareholders and not to achieve certain public policy goals or objectives. So I think we have pretty much come to the end of the questions that we have. I think one last question, which is very generic. What do you think should be the do's and don'ts for mutual fund investors? I'll just use that question to sum up some of the points that I hope I've been able to make. The challenge in equity markets is markets will remain volatile. Do not hope, do not presume that there is a golden story for India in which markets will not be volatile. Markets will always find a reason to be volatile. The way to the way to invest in equity and to earn returns from it is to be able to design a strategy in a way that the market volatility does not impact you. It does not cause you to get greedy and overinvest in equity. It does not cause you to become fearful and pull away from equity. And the truth in equity is that when valuations are cheap, the news will always be bad and scary and want you to pull back from equity. Whereas you have to do the opposite, move towards equity when the news is bad, because that is when valuations are cheap. On the other hand, when the news is positive, equities very often tend to be valued richly. They almost, invite you to come in and participate because money making looks very, very simple. That is the time you should actually be fearful, because the valuations are not supportive of your argument, even though news flow may be supportive of equities. So I think it is this ability to be able to counterbalance the narrative which is really crucial. It boils down to managing your temperament. As the very famous investor Warren Buffett said, you do not need to have a high intelligence quotient to be successful in the stock market, but you need a very high emotional quotient to be able to weather the stock market. And to my mind, that is really the key to be able to navigate the stock market. So, having shared those wise words from one of the greatest investors of our times, I think that pretty much brings us to the end of this session. I hope you found it interesting. I hope the method that we used today to show you a presentation and sort of be able to explain UTI's investment process and how that can be used as a prism to understand market behavior, and then finally coming down to valuations and to how we think the market is positioned, added some value to you. Thank you for joining us today on this broadcast, and we look forward to connecting with you again next month. Thank you.